And now I ask Jochen Andritzky to offer his view about the magic triangle.
Good morning. My name is Jochen Andritzky. I'm joining from the German Council of Economic Experts, and I'm very pleased to be here. Thank you for coming and joining this talk. Just a word about the council. The German Council of Economic Experts, in German Sachverständigenrat, is an independent policy advisory body established in 1963, and I think the most prominent publication is our annual report. So every year we write a thick report that's handed over to the German government. And in those reports, previously we were part of developing the Agenda 2010. We have made a proposal during the crisis called the Redemption Fund, a way to tackle the very high public debt that shot up during the crisis. And more recently, for the euro area, we developed a concept dubbed Maastricht 2.0. You called it Eurozone 2.0. We have called it Maastricht 2.0. And as part of that, last year we also specified our proposal for ways to regulate and enable orderly sovereign debt restructuring in the euro area. And I think this is what earned me the invitation to this conference. Thank you very much. Let me start by a grand picture on debt. I think this conference is largely about debt, so I thought it's useful to start with where we stand with regard to debt and where we went the last couple of years. So this chart splits up debt into government debt, the dark blue bars, non-financial corporations, the light blue, and the purple are the households. I leave out the financial sector, which is basically financial intermediation. And you can already see here that debt is not evenly distributed among those sectors. So we know, for instance, that Portugal is mostly a very high corporate debt, and we do know that Italy, it's mostly an issue of public debt, and of course also some bad debt in the banks. And what is also added here is to give you an idea of to what extent the very easy monetary policy we had in the last couple of years helped to reduce the debt, because that's probably one of the most prominent effects that the monetary policy can have on balance sheets. And indeed, I hope you can spot it, the numbers here show that in many countries debt declined. So notably in Spain, in Portugal, and also in Germany across the board. In Italy also, the non-financial corporations and the households managed to reduce the debt ratios. The public sector did not. Debt in Italy is as high as it was basically in 2014, before the QE started. Let's zoom in hence on public debt. The left chart is similar to what was just shown for a couple of countries, which is Maastricht debt before and after the crisis, 2017 and the latest. You see Italy, and together with Portugal, has very high debt ratios. And that's only Maastricht debt. We have, in addition, I think through the crisis, contingent debt, bank guarantees, other guarantees, and contingent liabilities, since what in the crisis, which was a massive shift of debt from the private sector towards the public balance sheet, we also, I think, to a large extent, created expectations of bailouts. So whenever debt on other balance sheets go bad, the public sector will take care of it. And the higher debt that was accumulated is basically a manifestation of that. So when we talk about how to tackle that in the future, there are three drivers of the debt ratio. One is obviously the budget deficit. One is the interest rates, so what is the cost of refinancing that debt in the future? And one is growth. And growth, last but not least, also has to do with public revenues and the budget deficit again. So let me talk to each of those three drivers in turn. So the right chart gives you a longer-term perspective of where budgets stand. And I use there the S2 indicator that's also used by the European Commission. Actually, the numbers are from them, which is the required budget adjustment if countries wanted to lock in the current debt ratios into eternity. So it's not about repaying debt, it's just about keeping the debt higher in Italy, lower in Germany, but keep it constant over the very, very long run. And so you see that some countries have, in the dark blue bars, still some adjustment needs in terms of the current public deficit. But what kicks in most other countries are higher costs related to aging, health expenditures, demographics basically broadly. And there actually I put the chart in to also show that for Italy, the long-term challenge is quite a different one than for Germany, for instance, where demographic change is going to kick in 2030, and there, with the current state of the pension system, still very high burdens coming up that's probably be borne by the public sector. So for Italy, the issue is different. Demographics are more advanced, pension system works differently. So I'm saying here that in the long run, things might change. For Italy, the challenge is the current debt, and also with aging, some medium-term, challenges. But in the long run, I think we're talking about a different picture between those countries. So that's what I wanted to say on current budget deficits and future budget deficits. Then about the interest rates. So we all know that the ECB has implemented quite accommodative monetary policy in the last couple of years, and that has helped countries to reduce the expenditure for servicing the current debt. This is a chart that shows a simulation. If we would have had the interest rates, the entire term structure of interest rates, as in 2007 and keep it constant, vis-a-vis that, interest rates have fallen. So vis-a-vis that, countries realized interest savings, and these savings are printed here. So the annual saving for Italy is a bit more than 1 percentage point, 1% of GDP. So this is something that could be saved, that could help to reduce debt. As interests probably start to normalize, go up again, this effect, of course, will peter out, if not reverse. But already, as you see here, we had very low interest rates, or interest rates coming down for a while. It takes time until that eats into the debt stock. Only a part of the debt get rolled over at lower interest rates. So the effect, the benefit of that came through only over time, as you can see here. And also, if interest rates rise again, the reversal also will only kick in over time. So I don't expect that a normalization of ECB monetary policy will, in the short run, give countries a lot of trouble to service the debt. And lastly, growth. I think growth is key to everything. And what most people look at is actually the differential between growth and the interest rate, because that's sort of the two factors that, aside from the budget deficit, can drive the debt dynamics. And I printed here for the period, the 5-year period, 2015 to 19, what the IMF estimated growth and the interest rate, I mean G being growth, R being the real interest rate, would be in 2015, and where they think it will, or it was and will be today. And you see in all countries R, so the interest rates, are lower than were expected earlier, and growth higher. With one notable exception, Italy, growth hasn't turned out that great. So in 2015, the average growth was forecasted to be 1%. It turned out, and is projected now, at 0.8 for this 5-year period. So the debt dynamics, so when you build the difference between R and R minus G, I mean R and G, then you see that a couple of countries have negative signs here, like France and Germany. That means if they run a neutral budget, then basically debt comes down, and I think it explains quite a bit why Germany's debt has come down so rapidly. While in Italy, this dynamic is adverse. Debt still continues to increase. So that is all to say that growth is very important for debt dynamics, and low growth is an issue, and that should be the main focus of being addressed. So if you ask me about whether Italy's debt is sustainable, I will not be able to give you an answer. I think hardly anybody can give an answer. There's no threshold, there's no limit that is credible to give. But I think it's fair to say that debt is very high, that there's a very limited buffer fiscal space to absorb a future shock. And then I think it's also fair to say that Italy is a big country. If Italy runs into trouble, it's not that easy to be saved. So that's a too big to save phenomenon that probably applies to Italy. And in the following remarks, I plot out our view, and parts my personal view, for the future of sovereign financing in the euro area that might address these issues. So the first point here is that if we like it or not, we're likely going to see a normalization of ECB monetary policy. So that means higher rates, less QE, less purchases to the ECB, and everybody needs to adapt to that. There will not be a way around it. The second is, I think that the era of, so we moved from an era where we said, okay, we have a no bailout clause in the treaties. We moved from there to a regime where basically this no bailout clause was not really credible. It was not believed by markets. The crisis came. Many countries received a bailout, not all. And I think the political consensus is firmly on the side that we need, again, burden sharing in crisis, broader burden sharing, and that will help also, again, that market can exert its disciplining function, which might be distorted through in the current market where also ECB has a strong presence. And that could be achieved through the following. It could be achieved through a phase-in of a mechanism for sovereign debt restructuring, as I will outline in the next slide. For that, also required and consistent with that, is a phase-out of the privileges for sovereign debt in banking regulations. You already mentioned those. And last, but not least, I think this has to go hand in hand with a crisis mechanism that is stronger than currently it is. But that's not all. The third point I think is equally important, which is financial integration. So the euro area as a common currency thrives on the basis of financial integration, and we have to safeguard that. And the responsibility here falls a lot on member states, because it's the member states who, through sound policies, can safeguard the confidence of investors. It is not the European Commission, it is not a European body which can do the reasonable reforms, structural, civil service administration, courts, justice system, welfare systems, all these kinds of things. There's no European body. These are all national responsibilities for a good reason. That's also what the countries want. They want to keep these policies in national responsibility. So these policymakers are responsible for sound policies in the member states. What the euro area can do is it can provide support, it can provide conditional backstops, for instance, ESM being one. And what it also can, for instance, is provide a common safe asset, and I will also speak on that. So here's our proposal that we launched last year, how to orderly restructure sovereign debt, and as a part of ESM programs. So it is not a proposal that says basically if you don't want to pay debt, you restructure it tomorrow. It's a proposal that if there's a crisis and ESM is being called, you need to do something that safeguards the ESM's funds. It's an important creditor. And that also makes the ESM as effective as possible. In the last crisis, more than half of the funds in the programs were spent on servicing debt holders. The idea here is that as a part of an ESM program, the ESM conducts a debt sustainability analysis similar to what's done today. But then, initially, in the first stage, to first do basically a standstill and to ask bondholders to agree on an extension of their maturities so that during the duration of the ESM program, there's not a lot of rollover demand that drains the resources from the financing envelope the ESM or other institutions can provide and should better be used for fixing the economy. So in the first stage, it will be in our proposal, will be a fairly automatic maturity extension that kicks in at pretty low thresholds. So a proposal is, if you say the eligible debt for this maturity extension is higher than 60 or let's say 90% of debt to GDP, or the funding requirement is somewhere between 15 and 20% of GDP. These are all thresholds that are commonly used in these analyses. Or also to reinforce compliance and expectations of a bail-in if there's no compliance. We also propose that if fiscal rules are being violated and investors basically didn't budge about that, then also there will be maturity extension. And that maturity extension then allows everybody to stay in the room, doors locked, nobody can get out during the duration of the program. And then in the second stage, the ESM, once the crisis already, there's a shock hitting the economy. We don't know really is it a temporary shock? Will it have lasting damage on the economy? Will it only have temporary damage on the economy? It's very hard in the beginning to say where the country is heading. I think we all were taken by surprise how deep Greece's GDP had to fall and where it's stabilized today. So that is why a second stage is better done a little bit later, once you have a better view of what the shock is like and how the crisis can be overcome. And then in a second stage, do again a debt sustainability analysis, and then based on that decide, can debt continue to be serviced? Is there a need to reduce coupons, push out maturities, reduce the principal? Oh, sorry, that was the wrong key. Okay, here we go. So our proposal is probably not feasible given the very large debt to be introduced tomorrow. Our proposal is based on the consent of investors as part of the collective action clauses, as they have been introduced already, but we propose that these are being improved, and thus we call them creditor participation clauses. And rather than say, okay, we start doing this tomorrow, or we say we introduce a mechanism like that in 2030, which might not be credible, our proposal is that today we start phasing it in very slowly, or faster, depending on what countries want. So this is a simulation now. If bonds today would be issued with those, or would start to be issued in 2017 with those new clauses, how quick the stock of debt with these clauses would build up. So for Italy here, the blue line would be if all debt is being rolled over in this. Then you see the grayish area on top. This is basically when they hit the amount of these bonds outstanding hit the range of above 60% of debt to GDP. The red line would be if only new deficits would be financed that way. And I think probably it could be anywhere in between those two lines would be the speed with which you could introduce this mechanism. And one could basically also do it voluntarily, say, okay, there's this new class of bonds, it has these features that there will be a maturity extension if debt is above this and in a crisis. You're free, you have to issue a certain minimum, but you're free to also issue more. And I would bet that these bonds become a market standard and all countries will thrive and jump on these bonds to issue them. An issue that is coming up whenever we're talking about debt restructuring or bank restructuring, is the sovereign bank nexus. And this is a chart that should at the same time worry and at the same time maybe relieve an Italian audience, which shows the extremely high home bias and government bond holdings in Italy. So the different colors, the bottom is basically the portion of bonds being held by the National Central Bank. And you see that for those two points in time we marked here, they increased due to the PSPP program of the ECB. But then everything else that's not green is also other domestic holdings, banks, pension funds, households. And then the two shaded greens are the light green is the euro area for those countries for which this data is available, and the dark green is rest of the world. And you see that particular rest of the world has decreased holdings of Italian bonds. So for Italy, a debt restructuring is to a large part a national, for 60%, a national redistribution of wealth. Keep that in mind for anybody who wants to push debt restructuring for no good reason. It's a redistribution of wealth within Italy. The idea, of course, is that the euro area is financially integrated, so there's no home bias any longer. And so our proposal will only go hand in hand if you can't call the government bonds like the ultimate safe asset that receives a zero weight in banking for capital purposes of banks. It also then easily leads to the question, what else is then a safe asset in the euro area, except maybe German government bonds? And therefore, I think our proposal goes hand in hand with a discussion about a safe asset in the euro area. And I've outlined here, or contrasted, three different concepts that are here. And on the left hand, you see some criteria that these concepts might try to achieve. So Eurobonds, that's what Marcello also seems to favor, versus the SB's proposal, the safe bond proposal that I'm sure you're aware of. It's a pooling of government bonds and subsequently gets tranched into a very senior tranche and in a mezzanine and junior tranche, or just in a junior tranche, so that the senior tranche basically receives a very high rating and is called the safe tranche. And then a framework that I now call Maastricht 2.0, which is basically the implementation of what I just outlined before, without any additional instrument like these other two. Breaking the sovereign bank nexus through phasing out the privileges and bank regulation, I think that is in all three concepts that probably can happen. With SBs, you do need to reduce the privileges of the national sovereign bonds, otherwise nobody will be interested in buying a pool of government bonds. Why would you do that if you can continue to hold just a straight Italian or German bond? The Eurobond, of course, it will also break the nexus, presumably if people start to pile into Eurobonds. A low-risk asset pool is also provided by Eurobonds and by SBs, depending on the size of that. Obviously, in a system in which there's a sovereign default possible, this is not adding to the large pool of safe bonds. What needs to happen is countries need to reduce the debt so that there's enough buffer and crises are unlikely. Then market discipline. We can have different opinions about how important market discipline is, but at the end of the day, I think a differentiation in financing costs is a disciplining device that is quite effective. And of course, if there's just Eurobonds and nothing else, then this way to exert market discipline is gone. The SB proposal, or the SBBS proposal, is quite explicit that there still needs to be a national bond market which gives pricing signals. But of course, some of the higher interest rates will not feed through to the countries if there are SBs. Avoid a permanent transfer. That's basically a precondition of the unit at all. So Eurobonds will lead to a transfer. Then the question is it acceptable? Is it too large? Is it too small? SBs always have also some limited transfer. A proposal, as we stand right now, wouldn't have any transfer. And the last 2 points concerns crisis, and I think that's an objective which we all have in mind, that we want to prevent a sudden stop, and that also risk mutualization in crisis is something that some countries definitely want to avoid, including Germany. And on these, I think those concepts really differ. And SBs, despite being called safe, I think it is not sure what will happen if there's a buyer strike, for instance, for some countries' debt that's included in the SBs, whether the SBs will be able to be placed on the market or not, so whether it can actually serve this function. My conclusion from that is that even with the SB proposal, which I think has many good features, we will need a very strong crisis mechanism, so basically a strengthened ESM. Financial integration, that was my third point on the previous slide. I just want to emphasize that financial integration is also the greatest shock absorber there is. So calculations based for other currency unions or federal states have shown that it's the finance and the links, the capital exposures, financial exposures that have the strongest shock absorption capacity if there's a shock hitting. So in the EMU, overall shock absorption is not very high, but even within Germany or in the United States, shock absorption through financial markets is much greater than the blue bars, which is fiscal transfers. So I think that's important to keep in mind in the discussion on whether we want to focus on financial integration or whether we want to spend our time on a fiscal stabilization function and these kinds of things. And there I found this chart quite worrying, and the target 2 balances were already shown in the previous one. So the target 2 balances, that's a line here. You see that after spiking in 2012 for Italy, they are now increasing again. And the ECB and other central banks keep telling the story, okay, that's just because of the QE and these are foreigners selling the bonds, and then because they keep the account in Frankfurt, it's all sitting in Germany, the money. Of course, the money is sitting in Germany, it's not flowing back. That's a point, and that should be worrying. And when you look at the capital account statistics, then you also see the flows here. And the flows here, the bars, the yellowish bars, show the capital outflow that's here rolling over 4 quarters from Italy. And you see also, if you can spot the 2 different colors, it is not only foreign. The foreigners just started to reduce their exposure to Italy. It is mostly domestic. So that's domestic are basically diversifying into other places, if you wish. But the foreign outflow is also giving a worry. So financial integration is, in my view, a very important one, and countries need to build the confidence investors need to invest, to attract foreign investments. So to conclude, I think overall we do have a challenging recovery in the euro area. The current policy mix, the very loose monetary policy, but also expansionary fiscal policies in most countries, is overall quite favorable. It's a good time to turn around the economy, to do reforms. And these reforms, the structural reforms, are the key to higher growth. It is not a European whatever. It is the national effort on economic policy making that they retain a national responsibility, which is key for higher growth. The financial disintegration and the lack of fiscal space is something that's dangerous. So the road that Italy travels on right now, I would consider, is a fairly bumpy and a dangerous road. What I try to outline here is a consistent framework for sovereign debt. which of course needs to be phased in. So it's another word for addressing legacies, and I think legacies should be addressed rather forcefully. The Council has proposed this redemption pact that would, for instance, tackle the legacy of sovereign debt. That is something that, in theory, could be pulled out from the drawer again, a kind of mechanism to tackle the old high debt. And we need to foster financial reintegration. It will also require, the new framework would also require to remove the privileges, and by removing the privileges, you basically create the base for creating a common safe asset. And ultimately, we do need a crisis mechanism, and a stronger one, and to make it stronger includes that creditor will also participate in crisis resolution. This is a focus. We have many other topics to talk about, which are probably not the focus of this conference, but I'm happy to comment on any of these. Many topics to be talked about. And I think we do need to take the euro area forward, because as already Jacques Delors says, Europe is like a bicycle. If it doesn't move forward, it will fall over. And I'm sure he had in mind an Italian race bike. Thank you very much.